Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings, Yesha. It's fantastic to have you back on the podcast show. You had such great feedback when you were last on here, so I've been itching to find a way to have you back on.
Bilal, I really don't need any convincing to come back on the podcast at all. It is such a pleasure and a privilege to get to hang out with you today and to get to talk on all things that come from the incredible hive mind that is Bilal. So
That's great.
It was wonderful. Thank you so much for having me back.
Now, one thing I've found with your work over the past year is you've done a lot of work on crypto and regulation. And, to some extent in markets, because crypto fell out of favor, people have kind of ignored what's been going on with regulation and how accepted crypto is in general, or is it becoming more accepted in the system as a whole? So maybe we can talk a bit about this to start with. And obviously the elephant in the room is what's been going on with FTX and SBF and so on. So perhaps you could sort of lay out, the way you think that particular sort of bankruptcy and collapse has been affecting things.
Yeah, it's the question that no one can avoid in this space, which is what to do after FTX. But actually, it goes beyond FTX. It's been a crisis in centralized crypto finance more broadly, in the context of a number of major institutions that started collapsing after May 2022. So the first domino to fall, obviously, was Celsius, which had marketed itself as a quasi-bank. In fact, it gone out of its way to kind of highlight how banky it was, without having any kind of, obviously any kind of, formal bankification, as it were. In addition, obviously, there was Celsius, there was Voyager, there was BlockFi that followed after FTX, and so there had Genesis as well. So there has been a massive crisis in the crypto ecosystem with some major institutions to fall. So one of the interesting things to see here is that it's not really just been about FTX, and there's this larger sense of trying to create some form of governance, some specific tailored rules for crypto that can work to deal with some of its specificities. The need for the instrument to be a kind of bearer instrument using the kind of password, the private key, as a denoter of ownership, things like that. So trying to create some specific rules here have really become much more urgent following the collapse of these major firms that have dominated the crypto ecosystem for a number of different years. And I think what's interesting, what you mentioned here, Bilal, was the bankruptcy, because what's also happened are these bankruptcies that have become larger than life within the bankruptcy community and environment. So FTX, Celsius, major bankruptcies. The FTX bankruptcies involved 9 million creditors. Celsius has been a massive bankruptcy involving huge amounts of retail interest, which is very uncommon. They have raised their own particular issues within the bankruptcy context. And so it's interesting to look at these things in two ways, which is one, how do you govern these institutions during their life? How do you handle and create tailor-made rules for crypto assets? How do you then, understand what's going on in the bankruptcy context, which is very specific, trying to apply very traditional bankruptcy rules to this incredibly, cluster of an environment that has come about since May 2022, November 2022. How do you apply these traditional rules? And the bankruptcy court's trying, but again, it's not been a perfect solution for crypto. A number of things have remained very problematic. For example, poor customers that have been called unsecured creditors that haven't been able to get their money back, not clear if they will get their money back within the kind of confines of the traditional bankruptcy system. And that's actually a function of us not having any rules in place going into it. So these two things then, you can see them allied in this context where people have been screwed over because we've just not, been able to get decent rules in place for crypto. So, in the end, we're left to the bankruptcy court making all the decisions here.
And how would a bankruptcy court, go about establishing some kind of regulatory role? I mean, because aren't they just adding up the assets, liabilities, and just trying to liquidate and make the creditors whole. So, how does that connect to them somehow becoming a de facto regulator of sorts?
Yeah, so it's really incredible how much power the bankruptcy courts have within the U.S. economic system. When one looks at the Chapter 11 rule book, it gives just incredible power to single judges to decide the fate of billion-dollar companies by virtue of taking certain decisions as to how these companies might be potentially revived as going concerns. So the goal of the Chapter 11 process is to really decide whether or not a single company has going concern value. Is it worth saving for the future? So it's not a simple pivot to liquidation if you stop paying your debts. It's actually a stay. You stop the company's creditors from closing upon the company. You put a pause on everything. Then you go through its affairs. You try and cull different parts of its business. You decide who gets paid, in what order, what kind of classes you create for that. You decide what business lines are worth keeping, which ones are selling. These are all, major decisions that the bankruptcy court and the bankruptcy court judge has to sign off on, following, negotiations with creditors about how to deal with certain parts of the business. And so the court has enormous amounts of power, and that power has been very visible in the context of crypto bankruptcies over this last year. So in particular, major kinds of decisions have involved things like information and disclosure. So for example, the court in Celsius basically asked a specialized examiner, they're called, but really an investigator, to go into the company and produce a report as to what the hell went wrong. In that context, the examiner came up with an almost 700-page report detailing all sorts of horrible abuses, frankly, within the Celsius governance model, within the way it was run, how customers were treated, what the marketing was. And eventually what happened was, things coming from that report have led to, future outcomes about, how to figure out where the value in the company lies and what to do about, its senior management. In that case, Alex Mashinsky, who was the former CEO, he's in jail. Not in jail. He's been arrested, for potential fraud, for allegations of fraud. Some of that evidence has obviously been coming from what the bankruptcy court ordered in the context of this examination. So, disclosure is a very important part of what the court's doing. In addition, the court is making some really important allocative decisions. So, for example, what's the legal status of certain kinds of creditors? The most important question, frankly, in my mind, that the court has answered here is in relation to what kind of status crypto customers have when they put their crypto with a custodian, like Celsius, like FTX. So FTX, for example, on Celsius, they requested customers to put their crypto on the exchange so that, they're able to transact with it. In order to do that, one also provides the password. So the exchange can then handle some of these assets, or the Celsius can handle some of these assets internally. These assets were then pooled and commingled. And what that meant was that the customers basically lost their status as property owners of that crypto. They became simple, contractual, unsecured creditors in accordance with the rulings of the court in Celsius. And what that did profoundly was make these creditors unsecured creditors that would be last in line effectively to get paid, relative to, say, secured creditors, if they had their property intact, who would get paid very much at the top.
And obviously the customers, they believed that they were secured creditors implicitly.
Exactly.
by giving the crypto assets. They thought it was been custodied, and so it was ring fenced, and so it was collateralized. And so that was, in their mind, that was what they were entering into. But the reality was it was commingled and pooled, and they lost that status.
Exactly, Bilal. And you know how this works. I mean, if in like more regulated securities and commodities markets, like this kind of stuff just wouldn't happen.
Hmm.
We saw in the case of MF Global, for example, when John Corzine's company had commingled a bunch of customer assets and used it to invest in problematic products at that time. In that context, when MF Global collapsed, customers, all of their stuff was pooled and commingled. So that segregation had not properly happened. And so their assets had started to enter bankruptcy. So in that context, CME had to pay money. The Chicago Mercantile Exchange had to compensate the customers to the tune of well over $100 million at that time, because the rules had been in place to maintain segregation of assets, to ensure that assets never enter the bankruptcy in the first place. There are no such, rules in the context of crypto. And so in the end, it's the bankruptcy court that's left to apply its own conventional rules and its own particular ways of seeing the world. And so that has obviously resulted in exactly what you say, Bilal, which is, the customer is basically being completely toasted by suddenly discovering that money and savings and expectations and enthusiasm and passion that they thought, that they had a right to expect, that all of that stuff was basically up in smoke, that they were just simple contractual creditors that, who knows when they're going to get paid fully or if not fully, then even what kind of payment they should be expecting as unsecured creditors going forward.
But this also implies that, the bankruptcy courts are playing this outsized role in terms of making these big decisions about how the crypto market will probably evolve going forward. Where does that leave the SEC, CFTC, all these other regulatory bodies that you have?
Yeah, it's a great question. I think, my co-author and I, Robert Stark, he's a seasoned bankruptcy practitioner. We wrote a paper about this some months ago. And so, one of the big questions that we were trying to engage with was essentially that, like, what do regulators like this SEC, CFTC, the Consumer Financial Protection Bureau, like all of these different regulators that are looking to put their hat in the ring for crypto, what do they do in this context? Well, it turns out that the bankruptcy court has been in charge, and it has just enormous amounts of heft. So, the SEC tried to block the sale of Voyager to Binance, and it, put forward allegations that the token, Voyager's token VGX, was in fact a security, and also that, the Binance deal was problematic because of that, Binance.us and Binance were exchanges that the SEC alleged were violating potentially applicable securities rules. So the SEC tried to block that transaction. It came to the court to block that transaction, the bankruptcy court, and the judge in that case just told the SEC that they just hadn't put forward enough evidence that the bankruptcy court was going to allow the sale to go ahead. So the bankruptcy court essentially pushed back against the SEC in a pretty visible way in that context. SEC did not get the benefit of the doubt or the expansive discretion that agencies normally have in the US. The bankruptcy court basically said that we don't agree and you haven't presented enough evidence to get us to that point that we do agree. So it's clear that there has been a flexing of the muscles from the bankruptcy context, and that's very much par for the course for bankruptcy judges who are able to essentially void pre-agreed bargains, get rid of problematic contracts, sell off assets in a rush, in a hurry. They have enormous amount of discretion, and they've exercised it in this context, in the context of crypto, and that has had and that will have long-lasting structural effects in terms of shaping what things like terms of service look like, things like how custody practices look like, what kind of information potentially crypto holders are looking for from custodians. All of these practices are shifting in response to what the bankruptcy court has done. And so, it's very interesting to see that flexing happen over these.
Do these bankruptcy courts have expertise in markets? Do they have staffs of like financial experts and crypto experts that can inform the judge? What's the infrastructure like?
Yeah, and I wish I had my co-author here, Bob, who is in the court on a very regular basis. And I think, I imagine channeling him, he would probably say that the experts are the ones that that the lawyers are going to bring before the court. It's not the case that the bankruptcy court itself has some endogenous expertise in crypto. I think it's fair to say that a lot of crypto judges themselves that have been charged and tasked with these massive cases, these complicated cases, are probably the first to say that, we are just triaging here. We are firefighting here. We're trying to figure out, right, what the hell is going on here? We don't have that native expertise that, say, a formal agency like the SEC or CFTC might have had it had certain kinds of control or certain kinds of jurisdiction over crypto. That's why we have agencies in the first place, which is to bring expertise to the task of oversight. That is the entire, point of agencies like the FCA in the UK, for example, CFTC, SEC here in the US. Their entire job is to deploy and foster a sense of, expertise, experience, dialogue with the community, trying to create responsive rulemaking in the context of what they're doing. And so given that absence was very marked going into the crypto winter starting May 2022, the bankruptcy court essentially had to do what it could. It certainly doesn't have that specific expertise to the extent that they were able to buy expertise from lawyers, from examiners. I think they've done so. One thing to highlight is that buying this expertise has been incredibly freaking costly. So, for example, the Celsius legal bill is just ginormous, but it pales in comparison to the FTX bill, which for the first six odd months of service, the lawyers and other advisors charged something like $200 million in advisory fees. Now, something like that, $200 million, it's just hard to imagine. But these are the advisors that will get paid first, always. We lawyers wrote the rules, so we make sure that we get paid first. And furthermore, it means that recovery for those down the ladder, namely the customers, unsecured creditors, is going to be that much less. So there's a real freaking cost to not doing the regulatory work, because the court is buying expertise on the fly. And it's a generalist court that applies specific bankruptcy expertise, but in the context of any number of different types of cases, pharma, tech, telecoms, whatever, we're buying expertise, and that expertise is super expensive.
And as a side point, has the bankruptcy court said anything about the whole debate of whether crypto is a security or a commodity? I mean, that's been an ongoing drama with the SEC around.
Yeah, that ongoing drama continues to be an ongoing drama. So the bankruptcy court has very deliberately not waded into this debate. It has very deftly and very strategically and diplomatically avoided it for the most part so far. The consequences of declaring something to be a security in the specific context of bankruptcy has certain consequences in the very specific context of bankruptcy. So there's an argument for saying that even if the bankruptcy court had gone in there and said, we think it's a security, arguably that could have been just something for that specific bankruptcy context, rather than necessarily having a larger import for the marketplace as a whole. But even here, for the specific bankruptcy environment, the court hasn't waded into this debate. It came close in the context of Voyager, for example, where the SEC was trying to make arguments to suggest that VGX, the Voyager token, was a security. In the context of the Celsius bankruptcy, Judge Glenn in the Celsius bankruptcy has basically said that he's not taking a decision as to whether the CEL token, the SCEL CEL token, whether that is a security. He's not taking that decision. He's actually, left that undecided. And so these are questions the bankruptcy court has decided not to wade into. So that debate remains extremely live. It remains, deeply contested. And so again, it's created this hurdle whereby regulators are fighting over turf at this point, Congress having to decide what to do rather than us having some kind of roadmap, for crypto reform.
And then more generally, when we think about regulation as a whole, I mean, there's different ways regulation can come into place. You establish principles, you sort of prescribe certain things companies have to follow. Another way is through enforcement actions, where basically you sort of pick examples where you're going to impose an enforcement action and use that as a signal to all other entities in that ecosystem of what they can and can't do. So, when it comes to that type of thing, I mean, what's your view on regulation through enforcement actions?
Thank you for asking that, Bilal. I mean, I think, the buzzword over this last, year and a half has been regulation by enforcement. Not just in the context of crypto, but also more broadly, for example, in the context of tech combinations and mergers. So, for example, a number of agencies have been addressing new innovations within the marketplace through enforcement actions by making the argument that potentially these new kinds of innovations are entering into regulated spaces without necessarily going through the process of following the full rule book. And so, the agency has taken enforcement actions in order to deal with that. The SEC has been very, very active in this case, bringing a number of very high-profile actions here. In addition, obviously, other agencies like the FTC, the Federal Trade Commission, has been taking very strong enforcement actions against major tech companies like Microsoft, for example, Facebook and others, arguing that certain kinds of combinations are, violating antitrust norms. And so this has been a very topical and visible theme for this last year, which is agencies doing oversight by bringing enforcement actions as a way to create discipline and order for the larger marketplace. So I have a paper with my two fabulous co-authors, Chris Brummer and David Zering, that looks at the fact of trying to navigate this debate about whether or not this is a good or a bad thing. And in some cases, commentators have argued this is actually just an illegal thing, that agencies are overstepping their bounds by being so heavy on enforcement. They're not doing their job properly. They're going into new areas they shouldn't be going into. Is this really legal? And so what our work has tried to argue here is just to say that agencies have a ton of discretion when it comes to doing their job. They can do enforcement. They can also make rules. And so certainly there are some payoffs when doing enforcement. For example, agencies can be very high visibility when they're taking a massive enforcement action. It's very publicized. It has an enormous potential chilling effect on the marketplace as a whole. If you recall, Bilal, in like 2018, there was this big ICO trend, the initial coin offerings. A lot of them were super scammy at that time. And the SEC brought a whole bunch of enforcement actions, and that stuff just stopped, right? So there's a massive effect on arresting potentially fast-moving bad behavior in the market. Equally, there's some real risks that come from overseeing a complicated, highly technical marketplace that's innovating using just enforcement. For example, the rulemaking process, at least in the US, is designed to create tons of information and dialogue between the regulated marketplace and the agencies between the agencies and the marketplace the agency is trying to regulate. So when a new rule is going into the mix, one has to go through a process of talking to people, not just the industry, but everyone, including customers, including, other stakeholders, just having a deep conversation about what this rule is going to do. That process is so, so important, because if a rule's not going to work, right, the agency should know about it before the fact and change it, recalibrate it. So, for example, the CFTC, like way back when, had a rule with respect to algorithmic trading. That rule went out for notice and comment. Comments came back, it's not going to work for a variety of different reasons. That rule was abandoned. That happens a lot. So that process of generating information, generating conversation, generating collaboration, has a larger payoff than simply doing a rule. It creates just a lot of collaboration, information, depth of understanding for the agencies as well as the industry as a whole. And we lose that. if it's just an enforcement action or an enforcement-based approach that is guiding oversight in the field. Perhaps the most dangerous thing, I think, for those of us that are really excited and engaged in seeing the agencies do their job in a really responsive and an informed way, is the fact that agencies risk losing their authority over time, which is what we argue in this paper, that there's a lot of danger in agencies going into new areas only to see the courts push back against them and potentially undermine their larger authority. So, for example, the current Supreme Court, for example, is looking at something called Chevron deference. What Chevron deference means is agencies get a ton of discretion and deference with respect to how they do their jobs. Chevron deference is likely to be killed off in the Supreme Court in 2024. So that is the larger administrative law picture. There are other cases too, which have made it harder for agencies to have the fullest discretion.
So that Supreme Court ruling, just to be clear, then could mean that agencies have less leeway, had less discretion to be able to introduce these enforcement actions. That's what we're saying.
Potentially, they're likely to face a more stringent standard of review, right? Okay. So, the reviewability of agency actions is unlikely to benefit from the presumption that agencies have a lot of, deference and discretion in what they do. The current strand of administrative law basically gives agencies enormous amounts of room to maneuver in how they decide what they are doing and the ways in which they're doing it. So, for example, the choice about whether or not to take an enforcement versus rulemaking action is very much up to the agency, and the reviewability of that is pretty is pretty circumscribed for the courts. The courts don't have a ton of grounds in which to review that decision. They have some, certainly, if the court is acting in an arbitrary, if the agency is acting in an arbitrary or capricious way, or doing things in a clearly abusive way, then the courts can step in. But by and large, the agencies have a lot of authority. In addition, I think it's worth noting that something that's already happened is this introduction of something called, promulgation of this thing called a major questions doctrine. So the Supreme Court last year, yeah, I think it must be last year. I'm very confused at the time these days. That the Supreme Court has been talking about this new doctrine called the major questions doctrine, which is that when agencies are stepping into a gray area, that potentially this raises a kind of major question for the field being regulated, that this should go to Congress and not be decided by the agency. So again, if something raises a major question, if this is a new innovative phenomenon the agency is going into, where its discretion, its authority may be questionable, not clear how much authority it has, this raises a major question that could go to Congress, should go to Congress for ultimate decision. So what that does effectively is curb the ability of the agency to act in those moments, in those spaces. And obviously the ball is then back into Congress's court. Now, what that effectively does is really delay potentially the ability to get the agency to act in that context, and it's up to Congress. But as we know, Congress can be very slow to act in certain contexts. In the US, for example, Congress has been fairly paralyzed of late.
Yeah. And obviously, from the sounds of things, rulemaking sounds like the ideal way of doing regulation, but I suppose it's slow. That's one problem with it, that it takes an age for those rules to get established. And another one, I suppose, is that you could get regulatory capture, that the industry just takes over the rulemaking by, they're the experts and they kind of set the rules themselves. Having come from the banking industry, I kind of, familiar with some of these areas. What do you say to those two critiques of the problem with rulemaking?
Nothing is perfect, Bilal. As I think all of us know, there's no perfect world. There's no perfect solution. Rulemaking is messy. It's obviously messy. It does take time. It does require wrangling between the industry that might be lobbying, that might be pushing back. There's tons of rules that come forward and get pushed back. There's a lot of drama. There's a lot of, craziness involved here. But that's what we, that's what we do, right? Like that's what all of us are doing to try and create some kind of rules of the road that can create a guide map for us to forward new kinds of technologies into the marketplace in a way that is safe and in a way that protects the integrity of the market as a whole. Now, obviously, on the issue of regulatory capture, I mean, that's an age-old problem that all of us have been dealing with in the market. That has, that revolving door mentality whereby, for example, agencies, personnel can be hired by higher paying industries. That has been a danger for all time, where the private and public sector have a massive gap in the pay scale and the opportunities that might be offered to those, folks after certain points in their career. So that's something that we've always dealt with. There are potentially rules and conventions to try and deal with that. I think that the larger picture here is that agencies have the power to deploy a range of sophisticated tools, including but not limited to enforcement. And the question is, let's see agencies deploy that full sophisticated gamut of ideas and regulatory expression that they have access to.
Now, I did want to also talk about the structure of the market as well. Perhaps we can start with the crypto and financial markets. One area of crypto that many people are focused on as potentially becoming integral to, TradFi or traditional markets is stablecoins and CBDC. What's your sense of their role as a long-term sort of feature of financial markets?
Yeah, I mean, it's very interesting to see that dynamic play out, which is this pivot towards seeing stable coins, for example, being a accepted part of the financial markets architecture to enable a few things to be forwarded in the context of financial markets, which is one, more rapid payment settlement. So in the context of having payments that would traditionally settle in a day or maybe even multiple days, particularly in the context of international payments that can take anywhere up to 3 days, as you know, Bilal, to settle. It's a complete pain in the A. So freaking costly for businesses and others to send that kind of money and have it take so long to settle, that potentially instruments that are able to do that much faster, indeed, potentially in seconds, that saves a lot of money and time and worry. So that's one place where there's a use case that is becoming compelling. In addition is the potential for programmability, right? Which is that stable coins are potentially connected to code, automated code, smart contracts, as it's, colloquially known, that these payments are released in accordance with automated processes that can then mean that, things can work in a potentially much more predictable way, that folks can create relationships through smart contracts where stable coins enable that payment to happen automatically without people having to worry about it. So, this programmability is something that's a novel aspect potentially to the marketplace that can be deployed. And the question is, to what kind of scales are we looking at with respect to programmability? But certainly there's one, that's a potential for a more nuanced and interesting usage than perhaps we have in the current payment environment, where intermediaries have to release that payment once certain conditions are met. So, these two cases have been made for stablecoins. Now, one thing to just, be very kind of clear on is that stablecoins, at least the major stablecoins, USDC, Tether, for example, PayPal it's got its new stablecoin that, these are stablecoins that are being issued by non-banks. So Circle, Tether, and others. So these are non-bank products that are released across these public blockchains. So this is a different model from the very bank-dominated payments environment that most of us have grown up on and seen being, traditionally used in the context of financial markets. So it's interesting to see that development being a part of this stablecoin use case that is being made, which is to have these open layers, open access layers in the form of public blockchain, very different from the closed payment settlement system that we're used to, and having non-banks play a key role in that. So again, that's a new thing for the financial system as a whole, and is a new and interesting phenomenon to observe. Now, one thing that is also something that you mentioned, Bilal, is traditional finance grabbing onto this, and they certainly seem to be doing it in a big way. So JP Morgan has the Onyx coin, which has been used to settle internal payments. It's basically a tokenized representation of debits and credits that are owed between different JP Morgan entities, and they settle using this kind of Onyx coin, which is a kind of stable coin situation. So I think that we see a world in which tokenized payments, where tokens are essentially used to reflect payment entitlements, is becoming embraced, whether it be in the traditional stablecoin context or whether it be in this kind of TradFi context, where major institutions like HSBC, JP Morgan, Citi, and others are pivoting to tokenized forms of payment, for digitally tokenized forms of payment for their internal marketplace. So it's interesting to observe that.
And the last time we spoke, we talked a lot about the US Treasury market and some of the problems with just the microstructure of the market. It's a year on, a year and a half on since we spoke, and you wrote much about this. I mean, how do you see the functioning of the Treasury market?
Bilal, I don't know. I mean, I think things can always get worse. So let's never be, let's never be too, think that things can never get worse, but it's about as bad as I can imagine, frankly. I mean, I think, you've had guests on the show that have spoken to the macro strains the Treasury market is facing. I think Charlie McGillicuddy was, Charlie
McGillicuddy, yeah.
McGillicuddy, yeah. I struggle with this. But Charlie was discussing some of the macro strains in terms of the need to absorb a larger bill issuance, for example, the term premium. These are all macro strains the Treasury market is facing, but frankly, this market structure, this internal capacity for liquidity to be predictable and expected, that's completely and utterly fragile and remains fragile, and it's becoming even more fragile given the ways in which these strains are pressing on the system. So, for example, we've had primary dealers and others struggle to maintain the viability of these auctions. So just last week, for example, there's a third-year auction. It was a complete, shizzle show. It failed really badly. The expectation is that, the issuance of treasuries is going to have to ramp up to deal with the ballooning deficit. That was something else that Charlie mentioned on your show earlier. The fact is that the traditional buyers of treasuries, the countries like Japan and, China, for example, have been pulling back. The banks themselves have been pulling back. The bank purchases of treasuries is about $100 billion less, or more actually, since this time last year. So the question is, who's going to step in the middle to purchase this incredible issuance that is to be expected in this market? So the reliance has come to fall on the domestic household sector. Now, what that refers to essentially is not everyday people. That could be, certainly they might be included, but what it means is that it's hot money. It's folks like hedge funds, right, that are stepping into the mix, who are much more opportunistic about the trading that they're doing in this context. And so it's not like necessarily a buy to hold strategy from their standpoint, but it's a buy to trade strategy, whereby, folks are purchasing treasuries for a variety of different trades, including the famous basis trade, which has come under so much scrutiny lately, trying to capture the difference between the treasury and the treasury futures market. So using leveraged bets. So these are complications that have developed since we last spoke, Bilal, which is this increased issuance, the marginal buyer of treasuries changing from the traditional countries like China and Japan to much more hot money orientated buying, for example, in the context of hedge funds, that we have we have a struggle here to deal with liquidity that remains deeply problematic. Primary dealers are now facing increased strains on their balance sheets. They are coming to the market less. The Fed continues to sell for quantitative tightening, $60 billion a month. Before, it used to be purchasing $100 billion a month. So again, the strains on this market is massive. Unfortunately, Bilal, since we last spoke, that was early this year in January, the regulatory process, coming back to the conversation we just had, has really not moved forward at all. So we are no better than we were last year in that regulatory space, but the market has moved forward, is facing enormous strain. So unfortunately, things are not pretty at all.
Okay, well, that's quite chilling. And I do like your expression, chisel show.
Shizzle show.
Shizzle show.
I have
Nice.
another one, which is, cluster frazzle. In order not to say what I really think, but in the words that I would rather use, but this is a cluster frazzle as far as I can see.
Okay, that's great. Now, in terms of your research agenda, I mean, you cover a lot of ground, but what are any kind of new areas that you plan on focusing more going forward?
Yeah, I mean, I think there's a lot to explore in the context of what we are engaged in, Bilal, which is the market is incredibly generative, pun intended, in terms of its ability to produce new tech. And so obviously generative AI is one area, and how it integrates into finance is something that will remain, will be very interesting. I mean, what's super fun about finance is that AI, very powerful AI, has been at work for a number of years. So as both of us know, folks like high frequency traders, for example, have been using really powerful AI for ages for the algos to essentially trade in real time by themselves, analyzing natural language, responding to that, through trading and orders and so forth. So a bunch of my research prior to this was very much in that space. And so I think it'll be interesting to see the uses to which financial markets will be putting generative AI to, and seeing what kind of regulatory implications that has for, questions like liability, for example, or questions like trying to figure out, how to establish accountability structures and governance structures around those technologies and those who use them. Perhaps much more interestingly, in the context of the next iteration of payments, it's going to be CBDC. So something that we haven't spoken about are these new phenomena called central bank digital currencies, which is essentially the digitization of public money. A number of countries, including the UK, obviously, are exploring whether or not to put their national currency, paper money, into a portable digital format, natively issued on a digital, some kind of digital ledger. And so, it raises a number of questions. And so my co-author and I, Barry Friedman at NYU, we're looking at aspects of governance and surveillance surrounding that. So that's going to be a next iteration of CBDC and payments related to the research. But, the field here is very broad. I think, one paper that I have on an existing area, which is something that I'll be happy to pass on to you, Bilal, is Treasuries clearing. So one big question has been in relation to centrally clearing US Treasuries. So I'm going to, be doing a paper on that to kind of think through some of the implications of that idea. There's a lot of support for it. I'm a bit more skeptical. So I'd like to, put a professorial paper out there and see what happens.
That's great, Yesha. Now, as you know, I always like to round off our conversation with something more on the fun side. I know you're into your sort of movies and books and so on.
Oh,
so
sure.
and TV shows. So has there been anything interesting you've consumed on the culture side?
Yeah, I was actually really hoping to have this conversation with you, Bilal, because I'd love to get your reactions to some of the new shows, because I know that you are an avid culture vulture. One of the things that I got super into over the last month is a whole bunch of sci-fi, really great sci-fi on TV lately, which is I've loved Wheel of Time season 2. I don't know if you've seen it, season 1 and 2.
I saw the first few episodes of season 1, and I just couldn't get into it.
It takes a minute to get into it, honestly. It does.
Okay,
Do you like sci-fi or no?
I do. Yeah.
Fantasy, sci-fi. I mean, I think it takes a minute to get into it. It took me a minute. I wasn't super convinced for the first two or three episodes. I haven't read the books, but in the end, I really just I really just loved it, frankly. All came together super nicely in season 2. I was very much into it. Perhaps much more your speed, Bilal. I don't know if you've seen Foundation Apple TV.
I have, yeah, loved
What
it.
do you think?
Love it.
Loved
Yeah,
it.
I like it a lot. It's yeah, it's really expansive, and I like that. Both shows really well made.
Loved it. So I thought it was so well made too. And Apple's done a whole bunch of sci-fi, fantasy related programming, which has been amazing to see. And one I started yesterday night actually was the new Godzilla show on Apple TV. Which
The
monster?
Monarch.
Yeah, Monarch. Yeah, Monarch.
Yeah,
That's right. Yeah. I told you you're so much more up to speed than I am. So I started that last night and it looks pretty freaking awesome. So
Right.
that's one to watch. And I think one that I enjoyed that's kind of more in our space, which I loved. I don't know if you've seen WeCrashed on Apple TV. With
I
Jared
haven't seen that one, no, but I know of it, of course. Yeah.
Fantastic. Absolutely loved it. And in another kind of iteration of that was Super Pumped, which is on Showtime and also on, I think it's on Netflix now as well, which is all about the rise of Uber and was an interesting watch as well. So that was
Cool.
definitely binged over a Friday night. So that another
Great.
recommendation.
That's great to hear. Yeah, I'll look out for some of them. Yeah, so WeCrash, Monarch, Wheel of Time. I'll give those a
And
go.
Foundation you've already seen, so we're done with
Yeah.
that. Yeah.
Yeah, great. Okay,
And
good.
and Super Pumped.
Super pumped. Yeah.
Yep,
I'll make
fun.
sure to watch that one as well. That's great. Well, with that, I mean, it's fantastic speaking to you, and I'll keep up with your latest research, and I'd love to have you back on at some time in the future.
But I'll come on at the drop of a hat. It's so grateful. I'm so grateful to get to be on the show with you. More than anything, I just love chatting with you. It's always so much fun. Your podcast, your work, you getting all of this, information, conversation, dialogue out into the marketplace and into the world is just an incredible service that you're doing. So whatever I can do to support, I would love to. But more broadly, just keep at it. You're awesome.
Great. Thank you. That's very kind of you. Yeah, likewise, you too. But thanks a lot.
Thank you so much, Bilal, for having me. It's such a pleasure.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.